In this video, I'm going to discuss an opportunity that I'm starting to see in the market with a specific sector that not a lot of people are actually talking about. I'm not seeing any videos around this sector, around people saying that there's a pretty decent opportunity with these stocks. I'm not seeing a lot of those videos because everyone is distracted with the darlings of 2023, which is actually the AI stocks. AI is the future. Now, this is why you see a lot of videos around something like Palantir or something like Tesla or some kind of Microsoft and also AI stocks. And if I did a video on these kind of AI stocks, I would get much more views than if I actually did a video on some kind of a boring retail stock that's being underlooked and no one is touching it because they're looking at AI. But as my goal is not to get the most amount of views, but to try to bring you the opportunities that I'm seeing in this market, I'm going to talk about this sector that I believe not a lot of people are actually talking about. And you notice that I talk about sectors a lot, and this is because I believe in something called sector rotation. It happens a lot. This is something I use to make pretty good returns over the years, and this is basically that every single year you have certain stocks, certain sectors that are shining and outperforming. But then there's other sectors that are being left behind. And the sectors that are underperforming, they tend to become the outperformers. And the ones that are outperforming and everyone is excited about, they tend to become the underperformers. And we have seen it in 2022, the outperformers were actually the energy stocks and the healthcare stocks, while the underperformers were the AI stocks, maybe Nvidia, the tech stocks, speculative kind of stocks, Cassie Wood stocks. And what happened in 2023? The energy stocks and the healthcare stocks are underperforming, while something like the tech stock and a lot of the others were outperforming. And you could see it in this graph that I put up. The Vanguard Healthcare ETF is pretty much flat on the year, while the technology ETF is up over 38%, which is why I was discussing opportunities in United Healthcare and CVS, which are now up around 10 to 15% in a lot of these names. But I believe there's still a long story with these stocks. I think there's a lot of other gains to be made in the healthcare kind of space. But this is normally what happens, and investors get excited at the wrong time. For example, if you remember in 2022, everyone was dying to get energy exposure. Why? Because energy was going up. But no one was getting kind of excited to get exposure to Nvidia. Although a lot of people bought it, I haven't bought it, and they did amazingly well. The only one I bought was Google, and I bought a lot of other kind of stocks. But I didn't buy Nvidia. But this was the best time to be buying them, when they were actually left behind. And one sector that's left behind in 2023, and this is a very exciting and interesting sector. It might sound boring, but to me it's very exciting, and I'm going to tell you why. And this is actually the defense sector, the defense kind of stocks, aerospace and defense. And if you look at these stocks, Lockheed Martin, LMT, is down around 6.5% year to date. Northrop Grumman, NOC, is down around 19% year to date. This is an amazing company, high quality defense stock, involved a lot of the space projects, a lot of things with the military. I mean, amazing stuff. A huge backlog, is down 19%. General Dynamics is down pretty close to 10% year to date. And RTX, which is Raytheon, is down around 16% year to date. Now, this is a time when we had war in Ukraine. We still have the war over there. We have a lot of geopolitical uncertainties. You have NATO allies trying to increase defense spending because of the uncertainty in the geopolitical space from between China and Taiwan, United States, things in Europe, things around Russia and Ukraine, a lot of in North Korea, a lot of risks, geopolitical risks that are happening. And NATO is increasing the defense spending to at least 2% of GDP. And I don't believe defense spending is going to go down in the United States, especially with such environment. So this is the best time to actually be owning these kind of defense stocks. And I believe they should be trading at a premium, but they are not trading at a premium. They're trading nowhere close to a premium, which is why I believe this is actually presenting a pretty decent opportunity. And if you look at where NOC is priced at, it's priced around 18.5 times earnings. Now, the mean multiple for it is around 17 times earnings. So it's still a little bit higher than the mean, but in my opinion, NOC is fairly valued. If you look at LMT, which is Lockheed Martin, is now sitting around 16.5 times earnings, which is much lower than 17 times. But it was trading at 17 times when we had no kind of geopolitical risks like we have right now. We didn't have such uncertainty. We didn't have such increase in defense spending like what's happening and what's going to happen in the future. And this is normally when these stocks enter a bull market. I'm very bullish on the defense industry. I personally believe it's entering a 10-year or 15-year bull market from increase in defense spending, and we're going to have a lot of uncertainty with a lot of those companies advertising stocks. If the Fed has to hike rates in the future, they're going to either make money and lose money. These kind of stocks have a massive backlog. Something like Lockheed Martin, they have a $158 billion backlog, while their market cap is $113 billion. So their backlog is much higher than the market cap. You have other stocks where they have their backlog 2 or 3 times or even 5 times, their market cap. So you don't have to worry about these kind of stocks missing big on earnings or not be able to make money because the Fed is hiking rate or because the dollar is going up and down. This is like an insurance policy. You're getting paid maybe a 5 or 6% free cash flow yield, and this free cash flow yield is growing 8 to 10% every single year, with something like the defense stocks with a huge backlog trading at a fair value. In my personal opinion, Lockheed Martin should be trading at 20 times earnings. This is just my view, at least 20 times earnings in this very high uncertainty kind of environment. Something like NOC with much more growth. In my opinion, NOC should be trading at least at 20 times to 22, 23 times earnings, growing free cash flow around 15% every single year. It's going to double over the next 5 years in terms of their free cash flow and with their backlog and all the projects that they are actually doing. So I personally believe not a lot of people are looking at the defense sector, and I'm very bullish on this industry. I actually own one defense stock. I'm trying to get into another one. I'm just being patient to see if I get a better deal in the future. I think this industry is pretty much fairly valued on the fundamentals, but if you think about the future and the increase in defense spendings and all the uncertainty we're having and we could potentially have, I believe you could agree with me that these stocks should be trading at a premium. And they used to trade at a premium last year, but now they're no longer trading at a premium, they're trading at fair value. And a lot of them are actually starting to get into undervalued territory. And I'm starting to get very interested. So I believe this is a sector or industry that most of you should monitor. I mean, I would much rather buy, something like a defense stock with a good dividend yield than something like gold for insurance or something like puts. Because if we have some kind of a market crash, unless it's March 2020, these stocks are going to go up. Just the way it is. It's more of an insurance policy that's actually growing. So I really like the defense stocks here. I own one. I'm trying to get into another one if the price gets right on a lot of those stocks. I believe it's not a lot of people are talking about it, and I think it's very interesting. So I hope you got some ideas in today's video. It wasn't financial advice, of course. Thank you for watching it, and I hope you enjoyed it. So if you did, please press the like button and maybe consider subscribing. So I hope to see you in another video.